The Golden Ratio Portfolio: How Ancient Math Beats the Stock Market. Look around at the world, and you will notice that nature has a subtle, recurring signature. From the spiral of a nautilus shell to the proportions of the Parthenon in Athens and Leonardo da Vinci's Mona Lisa, there is a mathematical constant that humans find inherently balanced and beautiful. That constant is the golden ratio, denoted by the Greek letter phi, approximately equal to 1.618. For centuries, artists, architects, and mathematicians used this ratio to create harmony out of chaos. But what if that exact same mathematical constant could be used to build an investment portfolio? A portfolio engineered to deliver stock-like returns while insulating your wealth from brutal market crashes. Most investors stick to traditional formulas. They put 100% of their money into the S&P 500, or they follow the classic 60% stock and 40% bond allocation. But as millions learned when both stocks and bonds cratered together in 2022, traditional models have severe blind spots. When inflation surges, interest rates climb, or growth stalls, traditional asset allocations leave your wealth vulnerable. Enter the Golden Ratio Portfolio. Developed by financial researcher and host of Risk Parity Radio, Frank Vasquez, this strategy blends ancient mathematical proportions with modern portfolio theory and risk parity. Today, we are going to break down the real research, the exact asset percentages, decades of backtested performance data, and how you can implement this strategy yourself. What is the Golden Ratio Portfolio? To understand why this portfolio works, we have to look at the mathematical logic behind its construction. The golden ratio comes from dividing a line into two parts such that the longer part divided by the smaller part equals the total length divided by the longer part. Mathematically, 1 plus $/SQRT $5 divided by 2 gives us approximately 1.618. In conventional finance, people like simple, round numbers. You will see allocations like 50-50, 60-40, or 80-20. But these arbitrary splits ignore a basic financial reality. Different asset classes do not carry equal risk or volatility. A dollar in physical gold behaves drastically differently from a dollar in short-term cash or long-term government debt. The Golden Ratio Portfolio solves this by cascading 6 asset classes in descending weights, where each step down is scaled by approximately 1.618. Here is the nominal allocation breakdown. 42% allocated to equities. 26% allocated to long-term treasury bonds. 16% allocated to physical gold. 10% allocated to commodities and managed futures. 6% allocated to ultra-short-term cash and treasury bills. Look closely at those proportions. 42 divided by 26 is approximately 1.615. 26 divided by 16 is approximately 1.625. 16 divided by 10 is 1.6. 10 divided by 6 is approximately 1.667. Every single allocation tier steps down by approximately the golden ratio. This creates a balanced distribution where heavier weights are assigned to assets that drive primary growth, while smaller, high-volatility diversifiers provide tactical protection without overpowering the portfolio. Breaking down the 6 asset pillars. Let us look under the hood of each component to understand how they work together as a synchronized system. First, we have the stock component at 42%. Vasquez does not simply invest in a broad total market index. Instead, he divides this 42% into 2 distinct factor buckets, 21% in large-cap growth stocks and 21% in small-cap value stocks. This equity barbell strategy is deliberate. Large-cap growth captures the earnings power and technological innovation of mega-cap market leaders during economic expansions. Small-cap value, on the other hand, targets deeply undervalued smaller companies that carry a historical return premium over long time horizons. Because growth and value factors frequently run on opposite economic cycles, when growth stocks struggle, small-cap value often holds up or outperforms, creating internal diversification within the stock sleeve itself. Second, we have 26% in long-term treasury bonds. Long-duration government debt acts as a powerful hedge against deflationary recessions and sudden equity market sell-offs. When economic panics strike, central banks slash interest rates, causing long-duration bonds to surge in price and absorb stock market losses. Third, we have 16% in physical gold. Gold is the ultimate non-fiat asset. Over decades of financial history, gold has demonstrated near-zero correlation to both equities and traditional bonds. It acts as an anchor during geopolitical uncertainty, sudden currency debasement, and periods of high inflation. Fourth, we have 10% in commodities and managed futures. Managed futures strategies use trend-following algorithms across physical commodities, energy, currencies, and interest rates. They provide what quantitative analysts call crisis alpha, meaning they tend to generate strong positive returns during persistent, grinding market downturns and inflationary spikes. Fifth, we have 6% in ultra-short-term cash or T-bills. This modest cash bucket provides stability, preserves short-term capital, and ensures immediate liquidity so you can rebalance without selling depressed assets during market panics. Why risk parity and volatility weighting matter. If you examine standard portfolio construction, you will encounter a major structural flaw known as equity risk dominance. In a traditional 60-40 stock and bond portfolio, stocks account for roughly 85 to 90% of the portfolio's total volatility because stocks are far more volatile than bonds. That means your portfolio is effectively dependent on stock market conditions. The golden ratio portfolio corrects this using the principles of risk parity and volatility parity. To see why, look at the individual historical volatility, measured by standard deviation of each asset class. Large cap growth stocks, approximately 21% standard deviation. Small cap value stocks, approximately 19% standard deviation. Long-term treasuries, approximately 13% standard deviation. Physical gold, approximately 26% standard deviation. Commodities and managed futures, approximately 24% standard deviation. If you weighted these assets equally at 20% each, the intense volatility of gold and commodities would dominate the portfolio. But by sizing the allocations according to the golden ratio, 42% stocks, 26% long bonds, 16% gold, 10% commodities, and 6% cash, the overall risk contribution of each asset class balances out. When you multiply each asset's portfolio weight by its standard deviation, you get near-equal risk footprints across main macro environments: economic growth, economic contraction, inflation, and deflation. No matter what economic regime the market enters, at least two of your engines are generating positive returns while shielding your total portfolio value. The hard research, decades of performance data. Theory is fine, but numbers are what matter. How has the golden ratio portfolio actually performed over real historical market cycles? Using historical backtest data spanning from 1988 through mid-2026, a 38-year period that includes the 1990 recession, the 2000 dot-com bust, the 2008 global financial crisis, the 2020 pandemic crash, and the 2022 inflation surge, the findings are compelling. Over this entire multi-decade timeline, the golden ratio portfolio generated an annualized compound annual growth rate, or CAGR, of 8.87% to 9.56% in nominal terms. Adjusted for inflation, that represents a real return of approximately 6.2% to 6.6% per year. For comparison, pure stock market indices returned around 10% over similar periods, but investors had to endure terrifying drawdowns exceeding 50% during market crises. Where the golden ratio portfolio truly shines is in its risk metrics. Volatility. The annualized standard deviation of the golden ratio portfolio was just 8.13% to 9.19%, roughly half the volatility of the S&P 500. Maximum drawdown. During the 2008 financial crisis, when stocks fell over 50% and traditional 60-40 models fell over 30%, the golden ratio portfolio experienced a maximum peak-to-trough drawdown of only negative 17.28%. Recovery time. It took the portfolio just 27 months to fully recover to new all-time highs after its worst drawdown, compared to over 5 to 6 years for standard equity portfolios. Sharpe ratio. Because of its smooth growth path and low volatility, the portfolio yields an impressive Sharpe ratio between 0.82 and 0.86, compared to roughly 0.45 for pure stock portfolios over long periods. Safe withdrawal rate. For retirees or financial independence investors taking money out of their portfolio, data demonstrates that the golden ratio portfolio supports an annualized safe withdrawal rate of 4.7% to 4.8% over 30-year retirement horizons. That significantly outperforms the classic 4% rule while reducing sequence of returns risk. How to build and rebalance the portfolio today. Building this portfolio in a modern brokerage account is straightforward and low-cost using 6 exchange-traded funds. For large-cap growth, 21% in Vanguard Growth ETF, ticker VUG. For small-cap value, 21% in Avantis International or U.S. Small-Cap Value ETF, ticker AVDV or IJS. For long-term bonds, 26% in iShares 20+ year Treasury Bond ETF, ticker TLT. For physical gold, 16% in SPDR Gold Mini Shares Trust, ticker GLDM or GLD. For managed futures, 10% in IMGP DBY Managed Futures Strategy ETF, ticker DBMF or KMLM. For cash equivalents, 6% in SPDR Bloomberg 1-3-month T-bill ETF, ticker BIL. To maintain the golden ratio allocation, set a simple rebalancing rule. Rebalance once a year on January 1st, or whenever any individual asset allocation strays more than 5% away from its target percentage. When an asset surges, you trim the profits and buy whichever asset is temporarily down. This forces you to systematically buy low and sell high without emotion. Conclusion: engineered peace of mind. The golden ratio portfolio is not a speculative moonshot. It is an exercise in structural financial engineering. By combining growth stocks, deep value, long-term treasuries, real assets, and trend-following managed futures in proportions inspired by universal geometry, it solves the fundamental trade-off between growth and security. It gives you equity-like compounding with bond-like stability, allowing you to stay invested through every financial climate without panic. If you found this breakdown valuable, hit the like button and subscribe for more deep dives into research-backed investing strategies. Thank you for watching and see you in the next video.